My name is Blaine Anderson. I'm a certified financial planner and tax smart wealth advisor. One of my favorite strategies to consider for clients is the use of Roth IRAs. Also, we consider opportunity zone investments for capital gains that are realized throughout the year. Both of these strategies help us get money into what we consider to be tax-free growth accounts, whether it's a Roth IRA or whether it's an opportunity zone real estate investment. We also really like the use of health savings accounts. When used properly, they also provide for tax-free growth and withdrawals. These are three strategies that we implement. We have individual case studies that we share with our investors about how to do this. But we believe in not only diversification in your investments, but also diversification with your tax classification and your tax accounts. It's important to consider both. I want to share with you one strategy when it comes to Roth conversions. This is something that we often evaluate for clients, whether they're in their accumulation years or even in their retirement years. We feel that it gives extra independence to an investment plan and to a financial plan. One of the key things that we do each year is consider Roth conversions. I'd like to share with you a case that I've been working on today and some of the implications of a Roth conversion strategy. There's two parts to this. Let me share with you number one. This is just looking at a Roth conversion strategy. This particular investor has well over 90% in tax deferred accounts, money that's going to be taxed. We're taxing the crop. That's the difference between a tax deferred account like an IRA or a 401k and a Roth IRA, taxing the seed or taxing the crop. This particular client has the majority of their money in tax deferred accounts where they're going to tax the crop. They're over their lifespan and over their retirement, the average tax rate is going to be 24.71%. And the total taxes that they will pay on the withdrawals from their 401k is over $6 million. When we go and apply a Roth conversion strategy, where we seek to maximize the conversions, especially over these years now, before they have required minimum distributions, and even during the accumulation period. When we go from a normal strategy of taxable, tax deferred, tax free, they're going to be paying over $6 million in taxes. However, if I scroll down and we seek to maximize their Roth conversions, their average tax rate will go to 13.47%. So from a 24.71% to a 13.47%. That's over 10% in their average tax rate. The key difference here, and something that I thought I would point out that we found exciting, not only as advisors, but also to the client, is that when we apply a Roth conversion strategy, their total taxes would go from 6 million down to 3 million. And essentially, that creates a lot more net legacy, money that will be part of their monetary legacy and their household. Oftentimes, considering Roth conversions and trying to maximize that strategy can reduce your average tax rate and the total taxes you pay throughout retirement. We know as tax smart wealth advisors that the largest bill that you will pay in retirement is taxes. I love considering Roth conversions. The second part that we will often incorporate is the use of an oil and gas investment in the same year. Now, the merits of an oil and gas investment should be considered by each individual investor and associated with a PPM. The thing about an oil and gas investment is that they will usually provide 70 to 90% tax deduction on the invested amount. So a $100,000 investment can provide anywhere from a $70,000 to even $90,000 tax deduction. When we do that in the same year, they can offset that conversion. And the idea with it is that there's more money working for you as the investor. A simple example that I can give is when we take that range of 70 to 90% for the upfront tax deduction that comes with an oil and gas investment, we use an estimate of 80%. So a $100,000 investment will provide an $80,000 tax deduction. In a 35% marginal tax bracket, that equates to a $28,000 tax savings. What I'm trying to share with you is that when we combine those two strategies, oftentimes they work well together. They should be considered separately and can be considered separately and independently. But one thing that we have found useful is even doing those in the same years. Please reach out to our office. Let us know if you have some questions about either strategy or would like to consider the use and a combined approach of it from a tax and an investment standpoint. I'd love to talk about how we can diversify your portfolio from an investment standpoint, but also from a tax standpoint. Thank you.